Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I am the tax director here at Chris Cooper. Today I've been joined by my colleague Mahar Afzal and together we will be taking you through today's webinar. So the topic of today's webinar is how to prepare the corporate tax return. If you have missed any of our previous lectures, webinars on corporate tax, and we have been occasionally doing other topics as well, like excise and VAT. So you can always go to our YouTube channel. The handle is Chris Cooper, and you will find all these webinars there. And you can take a look if you want to get some insight on the topics which we have already covered. Now, coming to today's topic, how to prepare a corporate tax return. So now corporate tax return is being defined in the corporate tax law as information filed with the authority for corporate tax purposes in the form and manner as prescribed by the authority, including any schedule or attachment thereto and any amendments thereof. So this is what we will be discussing today because now we know that certain of the companies they have already completed their tax year. So the corporate tax return is now popping up in the MarTax portal for the companies, and they're required to fill this information. So that is why the topic of today is how to fill this corporate tax return. How does this corporate tax return look like in the portal? So the manner in which it is supposed to be filed, it is supposed to be filed on the Imara tax portal. Now, to file a corporate tax return on Imara tax portal, you need to be having an Imara tax portal account, and then you need to be registered for corporate tax. So if you're not registered for corporate tax, you will not be able to file your corporate tax return. So the first thing is to get the registration done. Now we know that earlier in the year in February, the FTA had introduced the timelines for the companies on when they need to do this registration. So that timeline was according to the license date, license month, which was mentioned on their trade license or commercial license or professional license. So basically, you have to follow that. So, for example, if the license issue month was January, the corporate tax deadline was to for registration was May 31st. If, for example, the issue date on the license was November, then the deadline for that would be November 30th, 2024. So we can register before the deadline, but if you do not register within the deadline, then there is a penalty of 10,000 dirhams for late registration. So first we have to make sure that we are registered. When once we are registered, then we will be able to file this corporate tax return and submit it on the portal. Now, when do we need to file this corporate tax return? That needs to be filed within the 9 months after the end of the relevant tax period. So it can be done before the 9 months, but after the end of the relevant tax period. So that is why I said that for certain companies whose first tax period have already passed, for example, for companies who have the year end of July to June. So for them, the first tax period is July 2023 to June 2024. So that is already passed. So now those taxable persons who are already registered, they can see this corporate tax return there. So they are able to find this, file this return. So they must file this return before the end of the 9 months. And they must also pay any corporate tax, payable that has come out within this 9 months after the end of the period. Now, like I said, if you are already registered and your tax period has been finished, has been over, so for now, if companies up till September who have the year end of September, they would be able to see this corporate tax return. If somebody has the tax year of January to December, they will not be able to see at the moment because their tax year has not crossed yet. So once you are registered and you have, your tax year has crossed already, you will be able to see in the MarTax portal, you will see the corporate tax sign there. You will go to that corporate tax, drop down menu. There you will see a corporate tax filing and refund section where the corporate tax filing would be there. When you go inside this, the return would be there, and then you can file or draft your return here and submit there and make any amendments here. When you will open this form in the MarTax portal, you will see 8 sections. The first section is taxpayer details, so it will give a bit of detail about the company. Some of this is auto-populated, as we will discuss later on in the slide, and some of it we need to fill. Then the second portion is about elections. So we know that under the corporate tax law, we need to make certain elections. So those elections, like for example, election for small business relief, election for the transitional rules, election for gain or losses if they are going to be on realized basis or not. So the different type of elections, if you want to be part of the qualifying group or business restructuring, so all these elections need to be made in this section 2. Now, in section 3 is for accounting schedules. Here in section 3, basically they are reproducing the financials of the company. We know that the starting point of the corporate tax liability calculation is the accounting net profit and loss. So here the tax authorities have asked you to reproduce the financials basically of the company, which will be coming from either the audited financial statements, or if you're not eligible to if it's not compulsory for you to have audited financial statement, then it will be from your internal books. So this information will need to be filled in the accounting schedule portion. Then they will start with the adjustment. Like we just said, that the starting point is the net profit and loss, and then we need to make certain adjustments and account for the exempt income before we can come to what is the taxable income or loss. So that is the portion which will be dealing with the accounting adjustments and the exempt income portion. Then we will be discussing the reliefs. So the next portion is for the reliefs. So the reliefs under the qualifying group relief or the business structuring relief. Then we have other adjustments, and then they will move on to the section of the where the tax liability and the tax credits, like for example the foreign tax credit, or the withholding tax credits, which right now is 0%, but in future that will appear here in the last section. And then after that is to review the whole application that the taxable person has filed, has filled, and then to make the declaration and submit the return. So essentially there are 7 portions in the return, and then it's the review and declaration. So now in the next slides we will be discussing each of these sections in detail. So the first one that we will discuss is the taxpayer detail. Like we discussed that some of the portion of this is auto-populated. So in the first schedule, whatever information you have filled in the corporate tax registration, we just discussed we need to register before we can file the return. So whatever information you have filled in your registration application, like the name, the entity type, address, any contact number, the mobile number, landline number, the email ID, that will be picked up from there, and that will be auto-populated. So there is a section there where if, for example, the information which has been populated is not correct, you can amend it. But if you go to amend, it will take you to the taxable person to amend this. It is, better to ensure that, this taxable person remains updated, so that, it is picking up the most current detail. We know already that, FTA can impose a fine if you do not keep your tax, payer information up to date in the portal. And if there's any change in the taxpayer information, like change in the entity name, or address, contact number, anything, you need to make that change in the portal. Otherwise, if you don't do that within 20 business days, FTA can impose fines on that also. So it is recommended that this portion should remain updated. If the registration has been done a long time ago, and the corporate tax return has been is going to be filed, let's say, the next year. For example, for Jan to December year end, the return will be filed in September. So there will be a lot of time passed between the registration and the return. So please ensure that the taxable person detail is being updated. Now, some of the taxable person detail, like we said, is auto-populated. Then some of the information they will be asking from you. So the first information that they will ask from you is that is the taxable person a partner in an unincorporated partnership. Now, what is partnership? Partnership is an arrangement between two or more persons. In UAE, there are two types of partnership. One is incorporated partnership, one is unincorporated partnership. Now, in incorporated partnership in corporate tax law is treated as a legal juridical person. So because it is distinct from its owner, so it is treated like a company. And like the example is civil, you can say like civil companies. And then there is unincorporated partnership. So what are unincorporated partnership? They are a relationship which are established by contract between two or more persons. It could be to carry on a business or a project. It is to share with, in the profit and loss of that project or business. And some examples could be like partnership, trust, joint ventures, consortiums, association of persons. So these are, which are joined by a contract. So these contracts can be verbal or written. So this unincorporated partnership in corporate tax law, it is not considered a taxable person in its own right, like incorporated partnership, which are considered as a separate person, and juridical taxable person, they are not considered as a taxable person in their own right. Instead, they are treated as fiscally transparent, and the corporate tax law taxes each partner directly on the share of the profit and the gain. So that is why this information is required here. Now, this taxable person can be a company as well. That is why it is popping over here. And you need to fill in the information for as many, unincorporated partnership that you are partner of. So that will come here where they are asking for the corporate tax TRN of the unincorporated partnership. Then they will ask certain more questions in the taxpayer detail. One of them would be what is the taxable person revenue drive during the tax period. Now, this information will be flowing later to other questions. For example, related to small business relief. So we know that small business relief applicable if your revenue is less than 3 million. So this information later on will flow. So that is why they're asking for this basic information to see that which elections are this the company eligible for. Otherwise, those elections will not pop up for the company. So again, they are asking for if has the taxable person financial statement been prepared under cash or accrual basis. So we know if taxable person revenue is less than 3 million, up to 3 million basically, then they can prepare the financial statement under the cash basis. If it is more than 3 million, they need to prepare it on the accrual basis. So that is why this question is popping up here. Again, that they want to cross check with how much is the revenue during the period. So, for example, if you will select more than 3 million, then you're not eligible for this cash basis. And that is why this information is required here. Now, then it is asking you, is the taxable person a member of a multinational enterprise group? Now, what is a multinational enterprise group? It is where two or more companies, the tax residence of which is located in different jurisdictions. So MNE is basically a group of companies where two or more of the companies in the group, they are the tax resident of which is located in different jurisdictions. So basically the companies are in different jurisdictions or including one single company having tax resident in one company and then being subject to tax and with respect to the activity it carries out through PEs located in other countries. So basically, you have to be in more than one country. That's the first condition. And the second is that the consolidated group revenue has to be equal to or more than UAE dirhams 3 billion 150 million. So if that is the case, then you are an MNE and they're asking you to check if you are part of an MNE group or not. Again, this is important because certain relief, like I said, small business relief, for example, there you need to, you cannot apply for that if you are a part of an MNE group. So that is why it is asking you to give this information in the taxpayer detail now, because it will link it later to the other parts of the form. Now, the other question it is asking is, that is the taxable person, tax resident in foreign jurisdiction under an applicable double taxation treaty. So we know that, resident person, so basically you can be a resident juridical person if you are incorporated in the UAE. If you are incorporated outside the UAE in a foreign jurisdiction, but you are effectively managed and controlled here, it can be natural natural resident, tax resident person as well. And then you can be a tax resident of more than one country under the double taxation agreement. So that information they are requiring here in the start, that if you are, also considered as a tax resident in some other foreign jurisdiction under the double taxation agreement. Then lastly, they're asking that is the taxable person incorporated or otherwise established or recognized under the laws of the UAE or under the laws of a free zone. So after this information, it moves to the free zone section. So in the free zone section, we know that, a qualifying free zone person would be a person who meets certain conditions. Those conditions is that they must be deriving qualifying income from relevant transactions. So we know that, there's a list of qualifying income is basically income if you are driving from the free zone person who is a beneficial recipient, or if you are driving, qualifying income from qualifying activities which have been given under the law from non-free zone person. So those so first of all, the free zone person needs to be earning the qualifying income. Then they need to have an adequate substance in the free zone. Then they need to satisfy the de minimis requirement. So the de minimis requirement, which is 5% of the total revenue of 5 million, whichever is lower. So they need to ensure that the non-qualifying revenue stays below that. They have not elected to be subject to corporate tax, and they have to comply with transfer pricing rules and documentations. And they also have to prepare and maintain audited financial statement. So now, if you see the first question, they're asking, has the taxable person made an election which applied to any of the preceding 4 years? So now we know that if you are, if you don't meet the qualifying free zone person status, or you elect not to be part of that of qualifying free zone person, then your election stays the same for the tax period and for the next 4 years. So if you do not meet the condition, you cannot be a qualifying free zone person in that tax period and in the next four tax period. So this information is not relevant to the first return, because right now you can see that it is grayed out because it's not relevant to this year, but for next year and the subsequent years, this will be asking you this question. Then it is asking if the taxpayer is registered in a free zone. Then it is asking if you want to make the election. So here it is asking you if you want to make the election to be subject to the standard corporate tax regime. Like we said, that a qualifying free zone person has to be one who is not elected for this. So if you want to be a qualifying free zone person, you cannot elect for this. The second is that they are asking that if you are meeting if the taxable person is meeting any of the requirements to be considered as a qualifying um, sorry, to be considered as a qualifying free zone person. Just a moment. Okay. So then it is asking that does the taxable person meet the requirements to be considered a qualifying free zone person? Now we have already discussed what are the requirements. So if, for example, a company is not meeting any of the requirements, let's suppose they don't have adequate substance in the UAE, or they are not able to maintain the de minimis requirement, they're reaching the threshold, or they've made the election, then they have to click as and no. And if they have also, opted to be subject to the corporate tax under the standard corporate tax regime, they are not meeting the requirement, then they will be clicking no here. Okay, then the second part, or the second section after the taxpayer detail we discussed was elections. So here the company has to make certain elections, and these elections are to be made in the first tax period, and they will be applicable to the rest of the tax period as well, and they're irrevocable except in exceptional circumstances where you will have to take the approval from FTA. So now the first one is the gain on loss on realization basis. So now the businesses that are preparing the financial statement using the accrual basis, now they have this option to elect or take into account the gain and losses on a realization basis. When we say realization basis, we mean that the gain and losses will be realized, or they will be accounted for when the asset is disposed of or sold off. So if you are making this election, then you need to make this election either for all assets and liabilities that are subject to fair value or impairment accounting under the applicable accounting standards, or only for the assets that are held on capital account. So one of these you have to choose. So if you are choosing to go for the realization basis, so the first thing is that if you are doing the accrual basis of accounting, then this election will come up. And if you want to go for the realization basis for choosing to account for the gain and losses, then it will ask you that do you want to go for all assets and liabilities that are subject to the fair value and or impairment accounting, or do you want to go for all assets and liability that are held on capital account. So this you will have to check. Then the second election it will ask you to make is for transitional rule. So now the taxpayer here, now this transitional rule, this will be only applicable for the first tax period. So here, this option will come where you need to make the election that if you want to adjust the taxable income for the gains which are recognized on qualifying immovable property, qualifying intangible asset, and all qualifying financial assets and liabilities which are owned prior to the first tax period. So you need to make the elections for all of these three groups. And this election has to be made, like we said, in the first tax period. It's only relevant to the first tax period because it is a transitional rule, and it is also irrevocable. So you need to, be sure of what you are taking the election for. So, like I said, that it will ask you for the election for all three groups of the assets. It will ask you for the qualifying immovable property. It will ask you for the qualifying intangible asset. It will ask you for the financial assets and liability. So you will need to make this election. Then the next election would be for the small business relief. So like we discussed before that, it was asking about how much, the revenue is for the tax period. So this here will get auto-populated. And then, it will ask, and this, that if it is a member of the Multinational Enterprise Group, this will also be, flowing through from the taxpayer detail where you had filled this out before. So that is why if you see it is grayed out over here. And then, it will ask you the question that does, the taxable person would it like to make the election for small business relief. Now, what is the small business relief election? So for small business relief is available to any taxable person who has a revenue of equal to or below 3 million in the relevant tax period and all previous tax periods, and it can elect to be treated as having no tax. So that person, if they elect this, that means they will be treated as having no taxable income in the period, and they will not be obliged to calculate any taxable income or complete a full return. So in case we do elect this, then your tax return form will close over here. There will be no further information. It will go directly to review the form and to declare it. So basically, only thing that it requires you to do is the taxpayer detail in this case. If you are electing for small business relief, so you will give that taxpayer detail, the detail that it asks you about if you are a qualifying fees on person or not, and things like that, because we know that a small business relief cannot be, is not eligible for somebody who is a part of a multinational enterprise or a qualifying free zone person. So that is why the information was selected before. So here, if you make the selection, then your return is a simplified return disclosed here. You only need to make the election for the gain and loss for realization basis and for the transitional relief. And then if the small business relief is not applicable for you, or it is applicable but you do not want to elect to go with the small business relief and you want to be taxed under the normal regime, so then the form will continue. So if you are continuing with the form and we are marking as that we do not want to be taking the small business relief, or we are not eligible for small business relief, so the next selection it will ask you is transfer within a qualifying group. Now, we know that a qualifying group is basically when you meet the conditions where the taxable persons in the group are judicial person that are also resident person, or non-resident person that have a PE in UAE. Either the taxable person has a direct or indirect ownership interest of at least 75% in the other taxable person, or a third person has a direct or indirect ownership interest of at least 75% in each of the taxable person. The people in the qualifying group, they cannot, those persons cannot be exempt person or qualifying fee zone person. The financial year of all the taxable person has to be the same, and all the taxable person, they have to prepare the financial statement using the same accounting standard. So if it is IFRS for SME, then all of them has to be applying the same accounting standard. Now, where an election is made to apply this transfer within a qualifying group, then the assets or and liabilities held on the capital account that have been transferred between the member of the qualifying group, they're treated as being transferred at book value. There is no gain or loss that arises from this transaction. The amount paid or received for the transfer, that will be treated as being equal to the value at which the transfer records the transferred asset or liability. So it is at book value. Now, this selection has to be made alongside. This selection is again, irrevocable, and it will apply to all future transfers of the asset and liability held on capital account by the transfer within the qualifying group in all the future tax periods. So you can see the question that they are asking there, that did the taxable person transfer any asset or liability to a member of the same qualifying group during the tax period, yes or no? And then if you do yes, does the taxable person wish to elect for the relief for the transfer within the qualifying group? So it is asking you to make this election here in this part. Then we move on to the election for the business restructuring relief. So similarly, like the qualifying group relief, there is a business restructuring relief in the corporate tax law, where in certain cases when the entire business or independent part of the business it is transferred in exchange for shares or other ownership interests, the business restructuring relief will apply to eliminate this corporate tax impact of the transaction. And under this relief, again, no gain or losses need to be accounted for when calculating the taxable income for either of the party. Now, there are certain conditions for this relief to allow. Some of these conditions are that the transfer is undertaken in accordance with and meet all the conditions imposed by an applicable legislation of UAE. The taxable person are resident persons or non-resident persons that have a permanent establishment in the UAE. None of them are exempt person or qualifying fee zone person. The financial year of the persons they end on the same date. The taxable person prepare the financial statement using the same accounting standard, and the transfer is undertaken for a valid commercial reason which reflects the economic reality. So if this is the case, then this business restructuring relief can be taken by the taxpayer. So again, under this election, they're asking, did the taxable person transfer a business or an independent part of the business during the tax period? under which business restructuring relief may apply. So you have to click yes or no. If yes, if you have transferred the business or independent part of the business to another company, then they will ask you, would the taxable person like to make this election? So here we need to make this election. So I think the last election that they will ask for is the foreign permanent establishment income. So now, if the taxable person have any foreign permanent establishment, then you will be able to make this election. Now, this election is that so to eliminate or reduce any potential international double taxation, then a resident person they can make to elect when they're determining this, when they're making this return, they can elect to have the foreign incomes that are, derived from the foreign permanent establishment exempted. So here, if you want this foreign permanent establishment to be exempted, the income of it, so then, you can make this election. So in case when we are deciding to exclude the income, expenses, and loss of the foreign permanent establishment from the calculation of taxable income, the election will only apply to resident persons, foreign permanent establishments which are subject to corporate tax. So one of the things is that it will apply to only those foreign permanent establishments where they're already taxed at least 9%. And also, if we make this election, it will apply to all foreign permanent establishment. We cannot make this election to only relating to one permanent establishment. So once we are making this, it will apply to all the permanent establishment and to all the income and expenditure then of all the permanent establishment of the company will be exempt in this case. Now here the elections are finished. So we have seen that is a foreign permanent establishment income election. Then we had the business structuring relief exemption. We had the qualifying group exemption. The business small business relief exemption. Election. And then we made the election for the transitional rules, and we made the election for the gain and loss to be on the realization basis or not. So here all the election part will finish. Then moving on to the third portion of the return, where it is asking you to provide the accounting schedule. So here, like I said, that mostly the financial information which will be already in your financial statements. If it is audited, we know that if any taxable person has a revenue of more than 50 million, or they are a qualifying fee zone person, they need to have audited financial statements. Otherwise, the information from your even unaudited financial statement or management account or books of account, you will need to fill this over here. So here, if you see the statement of profit and loss needs to be reproduced. So the operating revenue will come, the expenditure incurred in driving the operating revenue. Now see, if your financial statement is in some other currency, it needs to be converted to AED to be put over here. The figures you will take out the gross profit. Then it's asking for salaries, wages, depreciation, amortization, interest income, interest expense, taking out the net interest expense expenditure, gain on disposable asset, losses on disposal of asset. Then foreign exchange gain and losses have been asked to be put separately. Fines and penalties, donations, client entertainment expense, then other expenses, other non-operating revenue, dividend received, and then it is coming to the accounting net profit and loss. So this is how you will find this in the return. Then they're asking you to reproduce the statement of other comprehensive income over here. Write what is the income that will not be reclassified to income statement, what is the losses that will not be classified to income statement, income that may be reclassified to income statement, losses that will be reclassified, other income reported in under comprehensive income for the year. So basically, it is asking you to reproduce the statement of other comprehensive income over here in this portion. Then it is asking you to put your balance sheet here. So we have already put the profit and loss and the statement, and now we are putting the statement of financial position, which is the balance sheet. So it is asking you to put the asset here. It is not asking you the information about the current asset, just the total current asset. And then for the non-current asset, it is asking for some detail for property, plant and equipment, for intangible asset, financial assets, other non-current assets, and total non-current assets are coming there. So then the assets, then they're asking the liability the same way. For the total current liabilities, total non-current liability, then the equity, and then one information which they're requiring here is the total number of employees. So this information will need to be provided. Then this is the audit portion, like you already mentioned that you need to have an audited financial statement if you are a qualifying free zone person, and also if your revenue is exceeding 50 million during the relevant tax period. So here they are asking you some information about the audit. That first of all, have the statements been audited? Then what was the audit opinion? The some of the selections is it a qualified opinion in the audit report, an unqualified opinion, disclaimer of the opinion, or is there an adverse opinion? And they're asking you for what is the name of the auditor and what is the auditor's corporate tax TRN if it is available. So this information is also required. Then it is asking for the capital distribution schedule. Here you will have to add all the shareholders, and for each shareholder, they're asking what is the shareholder name, what is the shareholder's TRN if they have any, what is the Emirates ID, what is the passport number, what is the capital at the start of the tax period, number of shares at the start of the tax period, ownership percentage at the start of the tax period, capital contribution made during the tax period, distribution received during the tax period, nature of the distribution, remaining capital at the end of the tax period, number of shares at the end of the tax period, and percentage ownership at the end of the tax period. Now, this needs to be filled for all the shareholders. Now, a lot of this information, it might be coming back in the next tax return already populated, so we will have to see that, and then it will give you the option to amend it if there has been any changes. So here, so here this portion finishes for the accounting schedule. We've seen that it asks for the profit and loss account. So if we go back, it has asked you for the statement of profit and loss. It has asked you for the statement of other comprehensive income. It's asked you for the balance sheet, and it has asked you the information about the audit and the capital distribution schedule. So all this will come from your financials. Then it will start with the actual accounting adjustment and exempt income. So this is the portion where now it will take the income, the net profit of the accounting, and start doing the adjustment so that it can arrive then later on to the actual taxable profit or loss on which the actual tax liability has to be calculated. So the first question it is asking you is, as the taxable person realized any capital gains or losses during the tax period? So remember, we have already made the elections before in the election portion. So it is asking you for if there is any realized gain or losses. Does the taxable person account for any investment under the equity method of accounting? So now, what is this equity method of accounting? So the equity method accounting, it doesn't record the dividends as income like in the cost method, but it rather it is treating it as a return on interest. So basically, it is asking you that if you have accounted for any investment under this equity method of accounting, and if you have, then it is asking you to provide the share of the profit and share of the losses, which is relating to the investment accounted for under this equity method of accounting. Then moving on, it is asking that has the taxable person derived any accounting net profit or accounting net losses for unincorporated partnership that are treated as separate taxable person? Again, we already discussed this. It has already asked you this information before in the form that about the unincorporated partnership if you are partner in that. So now, if you have clicked that as yes, then it is asking you further questions relating to this, that what is the accounting net profit derived from that unincorporated partnership, what is the net loss derived from that unincorporated partnership, is there any gain on transfer, sale, or other disposal of an interest in an unincorporated partnership which meet the condition of the participation exemption, losses on the transfer, sale, or other disposal of an interest in an incorporated partnership which meets the condition of a participation exemption. So basically, if you are a partner in an incorporated partnership, then you will require to fill this. Otherwise, if you are not a partner to an incorporated partnership, which we have already discussed, then this will be checked as no. So now, has the taxable person recognized any realized or unrealized gain or losses in the financial statement that will not subsequently be recognized in the income statement? So it is asking you for this information again, that if there are any gains or losses which are not going to go to the income statement, then you need to give what are those gains reported in the financial statement that would not be going to the income statement, what are the losses which are reported in the financial statement, because it wants to make the adjustment for that which would be there in your accounting profit and loss. Then the transitional adjustment, again, it has already asked you to make the election. You have already told them that, for already made the selection for the qualifying immovable property, for the qualifying intangible assets. You've already made the election for the qualifying financial asset or financial liability. So they will be asking you that have the taxable person held any qualifying immovable property during the current period. So now it is asking you for the current period. Now, if you have made the election, which will apply to which is irrevocable and it will apply now to all what you have selected. So now it is asking you for the current period if there is any. Then it will specifically ask you for the qualifying immovable property. If you have checked this yes, that means that one of these things is applicable to you. So either the qualifying immovable property or the qualifying intangible asset or the qualifying financial asset or liability. So if you have checked this yes, it will ask you individually that has the taxable person disposed of the qualifying immovable property? Has it? Then the second question would be for the intangible asset, and similarly then for the financial assets and liability. And if you click that yes, yes, then it is asking you what is the adjustment that is required in respect of the gain on that elected immovable property which has been owned prior to the first tax period. Again, this is for the transitional adjustments. And this is for the qualifying financial asset. Like I said, it will ask you for each separately if you have checked that box as yes. And it is asking you for again the adjustment for the gain and loss for both the qualifying financial asset and for both the qualifying financial liability. Then it will ask you for exempt income. So now if any person, we know that, any dividend which we receive from UAE resident person, that is, unconditionally exempt. There is no condition for that and it is exempt from corporate tax. So here and they're asking you if you have received any dividend or any profit distribution from a UAE resident person. So if that is the case, we will be clicking yes. If you click yes, it will ask you what is the amount that you have received and you have to plug in that amount here. Now, if there is a dividend or other profit distribution we have received from foreign juridical person, then that is conditional, that is only exempt if you are meeting the conditions, if there is a participation interest in the foreign company. So the participation, some of the conditions are that the participation interest the ownership should be 5% or greater in the shares or capital of the participation, and it has to be held for at least a period of 12 months. So there are other conditions as well, like, it has to be taxed for at least 9% in the other jurisdiction, the foreign jurisdiction. So all the conditions need to be met. And then it will ask you that if you have derived any income or losses from this participating interest. If you click yes, then it is asking you to plug in the amounts for what is the income that you have derived from this participation interest. This is for qualifying participation interest. What are the losses that you have derived and income which was previously exempted under participation exemption which no longer meets the condition, then the losses which were previously exempted which no longer meets the condition. Now, this is not applicable for the current period since, this is the first tax return, so there will not be, this any amount to put here. But in the subsequent tax returns, then you will need to put in the amount if a participation exemption is not meeting the condition anymore, and then you need to make the adjustments for what was previously exempted here. Now moving on to the next section. So after the accounting adjustment and exempt income have been made, then they are asking for any relief. So we discussed, we have made some elections before for the relief under the qualifying group relief and the business structuring relief. So here it is asking you for more information for this. So now transfer within a qualifying group. So now the first question is, does the taxable person need to make any adjustment in the current tax period due to the clawback of the relief or transfer within a qualifying group? Okay, so this is also not going to be applicable for this first tax period, but in subsequent tax period, if you have made any transfer within the qualifying group, so we already discussed what is a qualifying group, there's certain conditions to meet. And if you have made a transfer, between the companies in a qualifying group, but then this relief basically is not applicable and will be clawed back if within the 2 years of the, making the initial transfer, there is a subsequent transfer of the asset or liability outside the qualifying group, or either the transfer or the transees, they cease to be become the member of the qualifying group. So if these two conditions, are met, then this relief needs to be clawed back if within 2 years this event takes place. So in either of these scenarios, the transfer has to treat the transfer as having taken place at market value, at the date of original transfer and shall account for any gain or loss that arise as a result in the tax return for the tax period in which the subsequent transfer occurs. So these are the adjustments that you need to make. So it is asking you that is there any adjustment that needs to be made due to the clawback of the relief. So again, it's not applicable for the first tax period, but later if in the first tax period you've made this transfer and within 2 years either the parties of the transferee have left the qualifying group or there is a subsequent transfer again outside of the qualifying group, so then you need to make this adjustment. Has the taxable person received any asset or liabilities from member of its qualifying group and transferor has elected for the relief for transfer within a qualifying group in a current tax period? So then this is the second question it is asking. If you will click this as no, so then it is just asking you to provide the excluded unrealized gain in respect of asset and liability which were previously subject to relief. Again, this will be for the next tax period, and right now it would not be relevant. Gains which were not previously recognized for corporate tax purpose due to the relief or transfer within qualifying group which has now been realized. So again, on these gains, losses which they're asking, and then any adjustments. So the last one, the first four ones they're asking would not be applicable for this tax period, but for subsequent tax period. But the other adjustment resulting from the clawback you need to put here. So if you have said that there is a clawback, so we need to put the clawback adjustments in this column. So if we have clicked as no for the clawback and but have clicked as yes for has the taxable person received any assets or liability from a member of a qualifying group and the transferor has elected for the relief for transfer within a qualifying group in the current tax period, if the answer to this is yes, so then it will ask you two additional questions, which is the gain subject to the relief, it will ask you to put that, and the losses subject to the relief, it will ask you to put that. The rest of the questions are the same, where they're asking you for the previously, the relief is what previously subject to this tax. And if we have clicked the transfer within a qualifying group as yes, and then the second question as no, so then these are the questions again. So there are different combinations of what it can be for a taxable person. So it will apply to case to case basis. But the questions are similar. They're asking what is the gain which is resulting from the clawback, what is the losses resulting from the clawback, and asking for the previously the asset liability which were previously subject to the relief. So it's asking you to exclude the gain and losses on that, and then exclude the gains which were not previously recognized for corporate tax purposes. Again, these adjustments which are from the prior period, it will not apply to the first tax return. Then moving on to the business restructuring relief. So we also had made the selection for the business restructuring relief. We discussed that there's certain condition which needs to be met. Now again, they're asking a similar question that do we need to make the adjustment in the current period due to the clawback of the business restructuring relief. So similarly, like for the qualifying group relief, this relief it will not apply if within 2 years of the initial transfer the shares or ownership interest in either the transfer or the transferee are sold, transferred, or otherwise disposed of in the whole or part to a person that is not a member of a qualifying group to which the transfer or transfer belong, or there is a subsequent transfer disposal of the business or independent part of the business which was transferred. So in either of these scenarios, the transferor shall treat the transfer as having taken place at market value at the date of the transfer and shall account for any gain or losses that arise as a result in the tax return for the tax period in which the subsequent transfer occurred. So this is the clawback which they're asking over here, that if this one of these event has occurred, so since we have taken it at book value, now we need to take it at market value. So again, it is asking you to choose this election and then answer the questions that are relating to that, and then put the information or the amount of what would be the adjustments in these cases. So again, there are a combination of you can choose no or yes, and depending on that, if you choose yes, then they will ask you to put the gains here. Otherwise, they are asking you for the previous period if there is any relief that needs to be excluded. This again will not apply to this first tax year return, but will be applicable for the future returns. So again, like I said, these are different combination of if you're clicking yes or no, Accordingly, it is asking you the question. So most of the questions remain the same. Only when you are clicking yes for the clawback, it is asking you to give that adjustment for this current tax period for the business restructuring relief, um, and uh, and so on. So now I will stop here till the portion of relief. So just if I go back to the first slide, we have already now discussed some of the portions. So we have discussed the taxpayer detail portion, where we had given the initial information, then the elections we had made there, then the accounting information from the financial statement, then we have made the accounting adjustments, and the adjustments for the exempt income, and we have also given any adjustments for the reliefs that we had elected for. So now I will hand it over to Mahar, who is now going to discuss with you the other adjustments and the tax liability and tax credit, and take you through the rest of the presentation. So Mahar, it is over to you.
Hello, Faiza. Thank you very much and really appreciate it for the fantastic presentation. And uh, thank you very much, guys, for joining us. And one thing is very clear from the presentation, and that is this corporate tax return is not as simple as the VAT return. This corporate tax return is basically pure application of the corporate tax law. If you start from the scope of the work, if you're starting from the transitional provision, if you're starting from the application of the law, calculation of the taxable income reliefs, corporate tax reliefs, along with this various other reliefs, taxable liability calculation, withholding tax, foreign tax credit, all these questions FTA is asking basically. And whenever you are addressing these questions, you need to be ultra careful because these questions, whenever you are answering these questions, the every question has some sort of logic and it will have an impact on your taxable income. So what we did, we tried our best whenever we're explaining these questions, when we're answering these questions, yes or no, we tried our best to give you the reason behind this, why we need to put yes and why we need to put no. Majority of the portion of the return Faiza has already covered, but still I would like to say some question like this is non-deductible expenses. We know this, we need to map the accounting profit into the taxable profits. Whenever we are mapping the accounting profit into the taxable profit, then we need to adjust the accounting income into the taxable income. Then we need to adjust the accounting expenses into the taxable expenses to make sure that amount that we are arriving, this is a taxable profit. These are not accounting profits. So 100% of the expenses, as we have claimed in the to arrive at the accounting profit, might be it will not be allowed to you to arrive at the taxable profit. These are the some expenses like non-deductible entertainment expenditure. We know this, we can claim only 50%. Non-deductible pension contribution, we know that we can contribute only maximum up to the 15% of the employer contribution. Charitable donations, we can claim if these are being paid to the qualifying public benefit entity, otherwise we cannot claim this. Expenditure incurred in driving exempt income, this is straightforward apple to apple comparison. If the income is not taxable, related expenses will not be allowed to you. The various example for this, like you are getting dividend local from a resident juridical person, it will not be subject to tax. If any income related to this, it will not be subject to tax. If you are opting the foreign tax exemption, like you have branches all across the globe, from that you claim exemption, then income will not be taxable. Then related expenses, they will not allowed for tax purposes as well. The objective is basically apple to apple comparison. If the income is not taxable, they will not allow the expenses to arrive at the taxable profit. Then dividend, we all know this, the dividend profit distribution of similar nature paid to an owner might be this dividend. As I mentioned, the dividend, if you are getting a resident juridical person, this dividend is not subject to tax without any condition. If you are getting from foreign juridical person, this is exempt subject to certain condition. We'll look into this. Then expenses get not income exclusively for business purposes, you cannot claim those expenses. Any other non-deductible expenditure they will not allow. Basically this is the adjustment of expenses to arrive at the taxable profit. One thing is important, you have not seen any depreciation, you have not seen any provision over here. Means depreciation they are allowing, provision they are allowing. So all these expenses need to make the adjustment. Rather expenses which are not part of this list, that will be allowed to arrive at the taxable profits. Then this is very important adjustment for the interest income or expenditures. This is part of the return as well. What is the rule for the interest income or expenditure? First thing they are asking, we need to net it out. We need to consider the net interest expenditure. We need to adjust the we need to adjust the income against the interest expenditure. Then what are the rules? First rule is this interest limitation rule is not applicable to the banks. This is not applicable to the insurance company. This is not applicable to the natural person. Second thing, qualifying infrastructure project. If you have a qualifying infrastructure project which is working on health, education, a lot of detail regarding this, then you can claim 100% interest while arriving at the taxable profits. Then the next is, if you are taken a loan from the related party and objective of the loan is to avoid the interest, might be taken a loan, you claim interest in your books, but the related party, which is your related party, that related party income is not subject to 9% tax, means you are shifting basically your profit from your books to the related party books. They said if the objective of the loan, you are taking a loan from the related party and objective of the loan is to avoid the tax, and this loan you are using for redemption of the share, repatriation of the shares, then the law is very clear. Law is asking this interest will not be allowed to arrive at the taxable profit. Then another rule is basically, then you're taken a loan from the non-related party, or you're taken a loan from the related party, but the objective is not to avoid the tax. Then in this situation, we need to look into this. Is this loan has been taken before the 9th of December 2022, and there's no changes in the terms and condition of the loan. If there are no changes in the terms and condition of the loan, and you have taken the loan from the 9th before the 9th of December 2022, then interest limitation rules are not applicable, and you can claim 100% interest. Then if you're taken the loan after 9th of December 2022 from the non-related party or from the related party, and objective is not to avoid the tax, then we need to look into the net interest. If the net interest is less than 12 million, you can claim 100%. If the net interest is less than 12 million annually, then you can claim 100%. If the net interest is more than 12 million annually, then you can claim 12 million or 30% of it, whichever is higher. Remaining interest will be carried forward for further period of tax year. These are the rules. And based upon the rules, they are asking questions. Okay, are you bank or insurance provider? Yes or no? Because this rule is not applicable on the bank and insurance provider. We know the logic. 12 million they are asking. Basically, these are the questions. Objective is to arrive. Objective is to arrive. I'm not asking based upon these calculations, your taxable profit will be calculated. No, you are providing this information to the FTA. FTA will do the analysis of the information. Might be they will do the corroborative of the information, take a corroborative evidence, then they will be able to arrive the return is correct, or they need more clarification on this. So as I mentioned earlier, you need to be careful while answering any question while submitting the corporate tax return. The interest capping rule, they're asking a lot of information, adjusted EBITDA. We know the 30% of adjusted EBITDA. Then they're asking current period, previous period, 12 million, less than 12 million, banks, insurance provider, all these questions. You can go through this, but it all pertains to the rule that I have just described it to you. Nothing will be out of the rules. Transaction with the related party. We know this, if there is any transaction with the related party or any transaction with the connected person, it should be subject to transfer pricing rules and regulation. The objective is basically it should be at the arm length price. The related party transaction, connected person transaction should be at the arm length price at the fair value. Various methods are there. Cost plus method is there. Comparable uncontrolled method is there. Resale price margin method is there. 5 methods are there which has been given in the OECD guideline, and same has been replicated in the UAE corporate tax law. So when we are applying those methods, the objective is basically to arrive at the fair value price, to arrive at the arm length price. So profit has not been shifted from the high tax jurisdiction to the low tax jurisdiction, or profit has not been shifted by paying huge amount of money to the connected person, like sadly to the CFO, CEO, officer, directors, owner. The amount has not been basically diluted. The profit has not been diluted. The fair amount of remuneration is being paid to the connected persons, and any transaction with the related parties at the arm length price, to make sure that that the profits are true, representing the true picture corporate tax. One important thing is here, whenever you are doing any transaction with the related party, usually if the related party in the different border, cross border, one related party is in the UAE, other is out of the UAE, usually TP rules are applicable. But in our case, in UAE, even related party, both of the related parties are in the UAE, still you need to do the benchmarking study. This is important. So these are all questions like where are the any transaction with the related party in the current tax period? Then what the first question, do you have any transaction with the related party? Yes or no. Addition as a result of adjustment, what type of adjustment? Might be you have done the transaction of the related party, not at the market value. You have done the benchmarking study. Might be you will be required to pass any adjustment to arrive at the fair market value. We need to report this as well. Where there be any transaction with the connected person, yes or no. We know what are the connected person. These are like detail of the connected person. They're asking name, TRN, payment, benefit, description. You can go through this, but important thing is you must be aware about the law while addressing these questions. Then there's income and expenditure derive the qualifying investment fund. Qualifying investment fund, 8% is exempt from the corporate tax, and qualifying investment fund is one of them. But this is subject to certain conditions. What are those conditions? That qualifying investment fund or the manager who is managing the qualifying investment fund, they are subject to oversight by the authority. This is the first condition. Second condition is the fund is being floated. I think this is the second condition. The first is the oversight authority. The second condition is fund is floated on the recognized stock exchange or widely disbursed. Third condition is the fund has not been established to not the fund has not been established to avoid the corporate tax. At fourth, the law says any other condition. For the any other condition, they brought one more decision. In that decision, they have classified REIT and non-REIT. There are some conditions for real estate investment trust, and others are all other funds other than real estate investment trust. Some conditions are specifically applicable for the real estate investment trust. Like first, they need to fulfill the first three conditions, as I mentioned earlier: oversight, widely disbursed, not to avoid the corporate tax. This is the core three things. This is the common condition for REIT and non-REIT. Then separate conditions are for the REIT. What are those conditions? Out of these, the first condition is the fund is managing a portfolio of more than 100 million. Then there should be two institutional investors. I think there's one more condition is there as well. These condition needs to be fulfilled, and again, fund needs to apply to the FTA to claim exemption. By default, this fund will not be exempt from the corporate tax. In the same way, there's some condition for the non-REIT as well. Means there are some common conditions, there are some specific conditions for the REIT and non-REIT, and after fulfilling all those conditions, you need to give an application to the FTA that you are satisfying all related conditions, then the FTA will give you exemption. If the FTA is giving you an exemption, then your fund will be exempt from the corporate tax. Otherwise, fund will be subject to tax. Now you can go through these questions. Basically, the first, has the taxable person been an investor in the qualifying investment fund? Might be you are an investor in the qualifying investment fund. The income that you are generating, might be this is taxable and might be this is not taxable. Now this is a relevant question. Taxable person share of net interest income. Taxable person share of net rental income, dividend, other profit distribution. All these questions you need to address. Again, going back to the basics, and basics are you must have a thorough understanding of the law before addressing these questions. Other adjustment or any other adjustment not captured above might be adjustment. If there is any adjustment, you need to mention it here. Tax liability. Once you are arriving at tax liability, then you need to arrive tax liability is 0% up to 375,000 for the mainland person. Brand at 9%. For the qualifying foreign person, 9% on four types of income. Those four types of any transaction with the PE, local or foreign, any non-zero rated commercial property or any income from the non-qualifying income from the qualifying intellectual property, that will be straightforward subject to tax at 9%. Anything other than this, it will be zero rated. Then you see the tax rates. Losses, then you need to adjust. Losses, we know the losses, basically losses can be carried forward for unlimited period of time, provided there is a continuity of business and there is a continuity of ownership. If there is no continuity of business or there is no continuity of ownership, then the losses cannot be carried forward for unlimited period of time. And whenever we're adjusting the losses, we can adjust maximum 75% of the taxable income of the relevant tax period. Any losses beyond that means 25% of the taxable income of the taxable person. Every year it will be subject to tax. Maximum it can be reduced up to 75% of the taxable income of the taxable person. Losses, as I mentioned, can be carried forward for unlimited period of time. Two conditions should be there. Any one of them, sorry, continuity of ownership or continuity of business. Then tax liability and tax credit, we need to calculate tax liability, adjust the losses. After adjusting the losses, then we need to adjust. These are the basically foreign tax credit, withholding tax. These things we need to adjust. After adjusting this, we will be arriving at the final taxable amount that on which we will be liable to pay the tax. So these are the very basic, I think, estimated provisional figures. These are the things you need to attach: financial statement, local file, master file, and qualifying intellectual property. These basic information might be FT will ask, the below document needs to be attached along at the time of the submission of the return. No, this is compulsory, it's not optional. In the VAT, we are not uploading anything, but in the corporate tax, we need to provide all this information. I think time is over, but still I'll take your 10 minutes, not more than this. Apologies for this. So we will go through, this is whatever we have discussed. This is a template of the FTA. I will go through. Simply, I have prepared one Excel file for you. I think it will be quite helpful for you. Okay. Might be a lot of you, they have the very good system. In the system, the number has already been mapped. Accounting profit is being mapped into the taxable profit, and the system is doing this automatically. There is the possibility good systems are doing this. If the systems are automatically mapping the accounting profit into the taxable profit, that's very good. In case the systems are not mapping the accounting profit into the taxable profit.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.